Midnight isn't for sleeping in this market. Midnight is when the room goes quiet enough for you to hear the machinery. In daylight, everyone watches the price like a scoreboard. After hours, the system watches pressure like a gauge. The dangerous move is rarely loud because it doesn't need to be. It just needs to happen when the pipes are thin and the valve is tight. That's the first twist. A hard shove down isn't always bearish, because sometimes it's just a way to bleed pressure before the needle reaches a level that forces the whole network to react. No headline required, no villain required, just timing. A round number like $100 doesn't matter because it's mystical. It matters because markets build habits, and strikes tend to cluster around clean levels, because humans like them and listings follow them. Once enough exposure concentrates near a level, hedging stops being a choice and becomes a reflex. The public calls it a breakout or a rejection. The system calls it a change in required behavior because the closer you get to the line, the more quickly the hedges have to adjust. That's why attack narratives are often a distraction. The real story is mechanical, because the market is a pressure chamber with three fixed points you can't negotiate with: the gauge, the valve, and the door. When any two of them move together, the third one usually moves whether you like it or not. Here's the part most people underestimate. One standard COMEX silver futures contract is 5,000 troy ounces, and the minimum price fluctuation for the outright contract is 0.005 per troy ounce, which is $25 per contract. Those aren't opinions. Those are the dimensions of the chamber you're standing in. So when you hear $100 silver, don't think about a meme. Think about notional exposure changing shape as you approach a round number strike region. On the CME Silver Quotes page timestamped December 25, 2025 at 7 hours 22 minutes and 23 seconds p.m. Central Time, a front-month SAY contract printed about $75.10, which tells you something sharp. The line at $100 isn't today's reality. It's tomorrow's geometry. And geometry is what turns calm into forced action. Now put the calendar on the table, because the calendar is a lever. CME's holiday schedule marks Christmas across December 24th to December 26, 2025, and that window doesn't just change who's at their desk. It changes what today even means inside the matching engine. CME's Globex holiday notes state that day orders entered after a product's pre-opening on Wednesday, December 24th, are for trade date Friday, December 26th, and can keep working until the Friday Globex close. That's a trap you can step into without noticing because your intent is now, but the system stamps it later. During the same holiday notes, Silver TC is flagged for an early close on December 24th at 11:25 a.m. Central Time. When time products compress like that, liquidity doesn't politely compress with them. It fractures, and fractures create pressure pockets. The clearing side adds another layer that feels boring right up until it bites. CME Clearing's holiday memorandum for Thursday, December 25, 2025 says there is no intraday cycle, and for the end-of-day cycle prices will be carried forward from the prior day, while initial margin requirements will be recalculated. It also states that banks are closed and settlement variation, performance bond cash, and collateral transactions will not be processed on the holiday. Read that slowly because this is the valve moment. Trading can exist while money movement is delayed, and that mismatch is where stress accumulates. If your position needs fresh collateral, you can't always push it through the pipes on the day you wish you could. The chamber doesn't care about your wish. It only cares about whether the valve is open. So the Christmas trap isn't sentimental. It's a sequence of thin hours, shifted trade dates, early closes, and a risk system that keeps recalculating while people assume nothing changes because it's a holiday. The market can still move in electronic time, and it can move on very little volume when depth is missing. Spreads widen because market makers defend themselves. Stops become easier to reach because the book is shallow. A small shove becomes a big displacement for the same reason a small hand on a valve matters when the pressure is already high. Silence isn't safety. Silence is low depth. Let's do the math together, because math is the fastest way to remove superstition. Here's the sharper edge. A 1 cent move in silver is 1 cent times 5,000 equals $50 per contract. And that adds up fast when you're carrying size or when hedges cascade. The market doesn't need to move $20 to hurt you. It can grind, then snap, then reprice your risk while the calendar quietly limits your ability to respond. When initial margin is recalculated into a holiday, the valve can tighten at the exact moment the room is thinnest. That's why the midnight move matters, even if it's only a few dollars, because it can shift the system from voluntary trading to mandatory action. You can be right about direction and still lose because you ran out of usable collateral when the valve asked for it. The gauge moves. The valve answers. The door doesn't wait. Picture a procurement manager who doesn't care about winning, because their job is simply to keep a factory breathing. They need silver on schedule for contacts, plating, or assemblies, and missed deliveries don't just cost money, they break contracts. On a normal week, they can spread purchases, hedge with futures, or negotiate a short-term supply agreement, and the pressure stays manageable. Holiday week changes the physics because time windows shrink while obligations keep their original size. When the calendar compresses, the market's breathing room compresses first, and the human breathing room compresses second. On Wednesday, December 24, 2025, a desk can still trade, but product hours and order behavior don't feel like a regular Wednesday, and that mismatch is where mistakes get stamped into the book. On Thursday, December 25, 2025, banks being closed means cash movement can lag the reality of risk, and lag is just pressure stored in a chamber. Your price can move today while your collateral can't move until the system allows it. And that is not a theory, it's a scheduling fact. The procurement manager doesn't experience this as volatility. They experience it as a phone call. We need additional performance bond. Or your credit line is being reviewed. This is the first real reversal. The hedge that was supposed to stabilize the business becomes the thing that demands fresh oxygen at the worst possible hour. Now make it concrete without myth. One COMEX silver futures contract is 5,000 troy ounces. So a move of 1 cent per ounce is 1 cent times 5,000 equals $50 per contract. And that's before you scale size. If a firm is hedging 200 contracts to cover expected usage, that's 1 million ounces of exposure. And a $1 move is $5,000, 200 equals $1 million in mark-to-market swing. A dollar doesn't sound like a crisis when you say it fast. But $1 million does when it hits a collateral schedule that isn't keeping pace with the screen. In a thin book, the move can happen quicker than the internal approval chain can breathe, because internal approval is human and the tape is not. The chamber doesn't care how reasonable your meeting notes were. The procurement manager also has a second battlefield that doesn't show up on most charts, the physical premium and the delivery timetable. If they need metal delivered, a futures hedge doesn't hand them bars. It hands them a mark-to-market that still has to be converted into inventory through vendors and logistics. When liquidity is thin, spreads widen and execution quality degrades. And that can turn a safe hedge into a jagged exposure because you pay more to adjust it. Meanwhile, physical suppliers can tighten terms when they sense stress, because they're reading the same gauge, just from the warehouse side. Two numbers can diverge in a way retail traders miss. The screen price can dip while the urgency price, what it costs to actually secure metal on time, doesn't dip with it. That divergence is the chamber hissing at the seams. If you want a mirror, look at moments when pressure moved faster than people expected, and notice the common feature. The valve tightened at the wrong time for the crowd. On September 15, 2008, when Lehman Brothers filed for bankruptcy, markets didn't just drop, they changed how trust and collateral were priced. And that change is a mechanical shock, not a mood. On March 27, 1980 Silver Thursday, the silver market experienced a violent break after a period of extreme leverage, and the lesson wasn't about a single trade. It was about a system where margin and liquidity can flip from flexible to ruthless. In early February 2021, silver briefly became the center of a retail-driven attention wave. And even if you ignore the narrative, the mechanics were obvious. Crowded positioning meets dealer hedging, and the gauge starts climbing. Each episode has different characters, but the same three fixed points: the gauge, the valve, and the door. So when you hear "this time is different," translate it into one question: did the plumbing change, or did the crowd just change its story? The modern market transmits pressure faster because execution and risk recalculation are automated. So the time between move and margin demand can feel shorter even when the rulebook is the same. That's why holiday windows matter more now than they did in slower eras. Because a small displacement in a thin hour can propagate into a larger repositioning before the next full desk returns. The surprise isn't that price moves. The surprise is the speed at which a mild move becomes mandatory behavior. People call it manipulation because it hurts, but pain is not evidence, pressure is. Now bring the camera to the physical side. Because force number one is the metal and the delivery machine that sits behind the paper. The COMEX silver futures contract is deliverable for 5,000 troy ounces and delivery is typically satisfied with approved 0.99 finest silver bars in the exchange's warehouse system, meaning the door is not a metaphor, it is a process with receipts and warrants. Warehouses categorize inventory, and what matters in stress is not just how much exists, but how much is positioned to be delivered without friction. When demand concentrates into a specific time window, the system doesn't magically create deliverable supply. It reallocates it, and reallocation has a price. That's the quiet part. Physical settlement pressure doesn't need a headline. It just needs a calendar and a finite pool of readily deliverable inventory. Here's what that pressure looks like from inside the chamber. As delivery approaches, some participants must choose between rolling forward, closing exposure, or standing for delivery, and each choice pulls on a different pipe. Rolling can be cheap when the chamber is calm, but it gets expensive when nearby demand is tight, because the front end of the curve starts to price urgency. Closing can be painless when liquidity is deep, but it becomes punitive when the book is thin, because your exit order becomes the event. Standing for delivery sounds decisive, but it transfers the stress from paper to logistics, and logistics has its own bottlenecks and financing costs. The crowd talks about direction. The professionals talk about settlement paths because paths determine whether pressure dissipates or accumulates. In this market, the metal is the gauge, delivery is the door, and margin is the valve, and the chamber always obeys those three. The second force isn't a rumor, it's a surface tension problem. Silver options on COMEX are American style, and each option is literally keyed to one COMEX silver futures contract, not some abstract exposure. The minimum fluctuation on those options is $0.001 per troy ounce. And on a 5,000-ounce contract, that's $5 per tick, small enough to look harmless, fast enough to build heat. When the underlying is above $25 per ounce, the exchange's strike listing rule stacks the chessboard. 40 strikes and 25 cents steps around at the money. Then another 40 strikes and $1 steps beyond that, meaning the tape can be surrounded by dense strikes and then suddenly thin out. That's why a round number like $100 doesn't behave like a price, it behaves like a seam in the pressure vessel. If the market drifts toward that seam while liquidity is light, dealers hedging delta can turn a mild push into a mechanical pull. And you don't need a conspiracy for it, just the fact that hedges are obligations, not opinions. Silence. Now stay with the mechanism. Because this is where the midnight part stops being poetry and becomes plumbing. When price is far from a large strike, hedging is slow. When price approaches a strike cluster, hedging accelerates because gamma steepens, and the market starts reacting to its own reflection. The reversal is brutal. The more orderly the move looks on a chart, the more crowded the hedging flow can become behind it, because dealers are trying to stay flat while everyone else is trying to be right. Do the math with me again, but this time it is about speed. A $0.25 strike step is 25 cents times 5,000. Equals $1,250 of notional per contract per strike, and it only takes a handful of strikes to move a dealer's hedge from small adjustments to continuous buying or selling. 2 short beats, closer to the strike, faster hedging, thinner air. And if the market is nudged during an off hour, the hedge flow doesn't ask who started it. It only asks what the delta is now. That is how a number becomes a lever. The third force is where people mistake risk management for stability. Margin is a valve, and the valve tightens when volatility rises, even if the price hasn't moved much in headline terms. On Thursday, December 11, 2025, CMES Margin Advisory shows a very clean example for COMEX 5000. Silver futures. The non-HRP outright performance bond levels are listed at 2000 USD maintenance and 2200 USD. Initial with HRP at 2200 USD. Maintenance and 24,200 United States dollars initial, and the advisory states the rates become effective after the close of business on Friday, December 12, 2025. Those numbers are not a prediction, they're a reminder that the system can reprice oxygen overnight. You can be directionally correct and still be forced out if the valve tightens and your cash buffer ain't still built for it. Here's the cold pivot. When margin rises, it doesn't just punish reckless traders. It also pulls liquidity out of the book because everyone starts hoarding cash. That hoarding makes the book thinner, which makes the next move sharper, which makes the next margin review more likely. Vacuum. Holiday processing turns that feedback loop into a stress test because the calendar changes what normal operations even means. CME Clearing's Christmas Day memo for Thursday, December 25, 2025, explicitly says there is no intraday cycle. Prices are carried forward from the prior day. Initial margin requirements are recalculated and banks are closed, so settlement variation and performance bond cash collateral transactions will not be processed. Read that again as a thriller mechanic. Risk is recalculated while the cash rails are effectively paused. If you get pressure in the pipe while the relief system is slower, the gauge can look calm right up until the moment it doesn't. This is the liquidity blackout most people never model, because they model price, not processing. One more reversal. The quietest sessions are not safe, they're simply underventilated, which means a smaller trade can move the same price distance and set off the same chain reactions. No noise, just math. So you don't need prophecies, you need a test. And a 3-point map you can revisit every episode. The gauge, the valve, the door. The gauge is spreads and responsiveness. If price travels farther than usual on ordinary volume during off hours, it's not mystery selling, it's a thinner order book. The valve is margin and funding friction. If margin requirements jump around known review windows, expect forced behavior liquidations, hedge reductions, and the ugly two-way spikes that make everyone feel cursed. The ending is simple, and it's not comforting. In a calendar trap, time compresses because the processing schedule and the funding schedule stop matching the trading schedule, and that mismatch is where forced flows are born. Your protection is not a story about who attacked, it's discipline about where pressure can build, round strikes, thin hours, margin review dates, and delivery-linked windows. This is educational content, not financial advice. And futures and options involve significant risk, including the risk of losses beyond your initial deposit. If you want the next piece, we'll all isolate the exact points on the holiday calendar where the system quietly switches modes and why the switch often happens when the chart looks the most boring. Punchline 1. The market doesn't hunt your stop, it hunts breathable air. Punchline 2. The midnight move isn't big. It's simply where the pressure has nowhere else to go follow for the next breakdown.